Hello everyone, welcome to another video. On today's video, we'll be covering key pointers like point of interest and concepts such as fair value gaps, order blocks, breaker blocks, imbalance of price, and so on. During my early years as a trader, I tried almost everything: support and resistance, trend lines, Fibonacci, retracement, indicators like RSI, Bollinger Bands, and even moving averages on their own. I chased every strategy hoping to find the one, but after years of trial and error, what finally clicked for me was understanding that the market is driven by two fundamental forces, which are supply and demand and the hunt for liquidity. Price is not random. It is based on the law of macroeconomics. In every action, every move, every spike, every dip is the market reaching for liquidity. These concepts I'm sharing with you aren't just theories, they are hard-earned truths I've proven through experience and time on the chart. So what is a POI? A POI also stands for point of interest, and it is a significant area on your chart where we anticipate a reaction. These are not random. They are formed based on previous price action, institutional behavior, or market inefficiencies. Examples of POIs include supply and resistance zone, supply and demand levels, fair value gaps, order blocks, and breaker blocks. The job of a trader is to identify these zones in advance and wait for price to return to them. Then we observe how price behaves from there, whether it gives us a confirmation to enter or signals us to wait. So I'll run you through some types of order blocks later in the video and show you live examples as well. So the first one I want to run you guys through is fair value gap. A fair value gap is a type of imbalance in price, an area where the market moves so aggressively that it left a gap between candles. This gap shows where buying or selling pressure overwhelmed the other side. Since the market seeks to always balance itself, price often returns to this gap before continuing to its intended directions. For example, after a strong bullish move, you might notice a gap between candles on the 15-minute or 1-hour chart. That's a fair value gap. And when price returns to it, it may give a great entry point if it aligns with your overall market structure. And the next I want to touch through is order blocks, OB. Order blocks are the final bearish or bullish candle before a significant move. They are where institutional players place large orders. When price returns to this level, it often shows sensitivity because big money has left a footprint there. A bullish OB forms before a strong upward move. If price returns to this area and holds, it could signal a continuation. But remember, we are not guessing. We are waiting for confirmation, such as a change of character or a break of structure before entering. I'll cover all these concepts later in the video live on the charts. The next I want to cover is a breaker block. Breaker blocks are somewhat different. They form when an OB fails. That means price first reacts to an OB but then fails through it, breaks through it. Later, the market returns to the same area, and this time it reacts against the original intent. This becomes a trap for retail trader and an hidden gem for those who understand it. Breaker signals a shift in market direction and often catch people off guard. If you can't learn to spot them, they become powerful tools in your technical toolkit. So I want to run you through the break of structure versus the change of character. In trading, understanding break of structure and change of character is essential for identifying market trends and reversal potential. A break of structure, also known as BOS, occurs when the market continues in its current trend. For example, in an uptrend, price forms higher highs and higher lows like we explained in the last episode. When it breaks above a previous high, it confirms the trend is still strong and still in an upward trend. BOS is a sign to follow the trend. In contrast, a change of character indicates a possible trend reversal. It happens when price breaks the structure in the opposite direction. For instance, in an uptrend, if price breaks below the higher low, it shows the bullish momentum might be weakening and downtrend could begin. Simply put, BOS means trend continuation, while change of character signal a potential reversal. Recognizing these moments helps traders stay aligned with market conditions or prepare for shifts. Understanding these two concepts can greatly improve your market exits and entries. Next concept I would like to touch on are imbalance and balance in price. In trading, balance and imbalance in price refers to the relationship between buyers and sellers in the market and how price moves when that relationship shifts. Balance price, also known as equilibrium. This is when buying and selling pressure are relatively equal. Price moves slowly, often consolidating or ranging. You'll see small candles, equal highs, equal lows, or overlapping wicks. It shows the market is in agreement and there is no side in dominance. Meanwhile, imbalance price, also known as inefficiency, is when an imbalance occurs of one side, that is buyers or sellers, aggressively overpowering the other. This creates strong price movement in one direction, leaving little to no trading activity behind. You often spot long candles with small or no wicks. This is called fair value gaps or imbalance zones, and price may later return to fill this gap. The next concept I would like to touch on is the market cycle. I want you guys to take this episode really seriously, because this is like a whole framework of everything you need to know from a bird's eye view of the way I trade, supply and demand. Understanding this episode is basically you kickstarting your journey, basically. So I'm covering real key concepts that will help your journey like throughout your trading career, basically. So first of all, I would like to visit the topic called market cycle. The market moves in a constant cycle of balance and imbalance. Balance areas are often zones of accumulation or distribution where price moves sideways, indicating a temporary agreement between buyers and sellers. These zones usually precede major moves. On the other hand, imbalances occur when one side outweighs the other, causing sharp directional moves, often leaving behind price gaps or inefficiencies. These imbalance areas tend to get revisited later as the market seeks equilibrium. Understanding this cycle helps traders anticipate reactions, reversals, or continuation. Be sure to master these rhythms. And I would like to run you through the 4 stages of market cycle, and they include: number 1, accumulation phase. This is where smart money quietly enters the market after a downtrend. Price moves sideways in a range as the market finds balance. Retail traders are often hesitant here due to prior losses. Then the next is advancing phase, also known as the markup phase. Price begins to trend upwards, forming higher highs or higher lows. Volume increases as more traders gain confidence. This is the uptrend. Momentum builds and opportunities to ride the wave appear. Then we have the distribution phase. After significant upward moves, large players begin to offload positions. Price consolidates or form a range near the top. Retail traders often enter late, just as smart money prepare to exit. Then the next is the declining phase, also known as the markdown phase. The market breaks downwards, forming lower highs and lower lows. Bearish sentiment grows, leading to panic selling. This continues until accumulation begins again, and it goes on and on. So why does this matter? Balanced areas often act as accumulation or distribution zones, while imbalances often get revisited as price seeks equilibrium. So these are the key takeaways from this, right? Market moves from balance to imbalance and back again. Recognizing these shifts help us as traders to anticipate where price may react, reverse, or continue from. So now I want to head into the charts, so I show you everything I've been talking about throughout this episode and help you understand and see the market from a bird's eye view. So come with me, guys. Let's get into it. Hi guys, so welcome back. I want to run you guys through the market cycle. As you guys can see, I've already ironed it out. So as you know, the market cycle comprises of the accumulation, advancing, distribution, and descending phases. Just like I explained previously, this is the accumulation phase. As you can see, there's like a range here, then it breaks structure to the upside. So we can call this what? A break of structure right here. This is the first break of structure, right? Then this is a major break of structure. As you can see, price ascends, then it creates another ranging structure because it's termed a distribution. Then it breaks to the downside, as you guys can see, right? So you can call this a change of character, right? Change of character, because it breaks to the downside and it continues the trend in a descending form. So this is basically how the market moves. This is basically the market cycle. Accumulation, ascending, break structure to the upside, distribution, and come back, and it does it over and over and over again, right? So that is basically the market cycle. So now I want to run you through what a break of structure is really. As you can see, when you want to know the break of structure, right, you move from here, the last red candle, right, that broke structure to the upside. This is where you draw your order block from. I repeat, the last candle, the last red candle that created this velocity move to the upside is called what? This is where you draw your OB from. But before we get there, I want to run you through what imbalances are, right? Because the imbalance happens somewhere around here, right? When this happens, 1, 2, 3, 4, 5, this is like velocity move now because buyers are already in control, right? So this move, 1, 2, 3, yeah, you mark your OB somewhere around here. So this is called an order block. As you guys can see, this is called a what? An order block. So this order block, price broke up to the it broke to the upside. So this is a break of structure now, a valid break of structure, right? Then price came back this way, broke structure to the downside as well. As you can see, this is a velocity move to the downside, changing the character as well, right? So I think I've covered these concepts, right? So we're about to go to the next concept, which is showing you breaker blocks, you know, fair value gaps, and how to spot them. Yeah, so come with me to the next slide, guys. Yeah, so we're back. I want to run you through the different kind of POIs that we have. First of all, so this is, I'm on the 4-hour time frame for GBP USD, also called the cable, right? So as you guys can see now, I'm not trying to go down into the smaller time frames because I believe this is a beginner video, so I'm trying to keep it as simple as possible, you know. So as explained on the previous videos, this is another block. As you can see here, this is a demand and this is a supply setup, right? As you can see, if I'm going to explain from the charts, this is a prime example of a demand setup. So if you follow what you're seeing here, as you can see, this is a break of structure to the upside from here. This is a break of structure. Price came back into this zone, you know, and that is it. This is simply put, I'm not trying to do anything extra or, you know, advanced here. This is a simple break of structure to the upside, came back, and it's continued, right? This is a major break of structure from the 4-hour. So price broke structure to the upside, came back to our order block, gave us a break of the candle, and is going back up, you know. So if I'm to go down into the smaller time frames just to see how this thing looks more clearly, oh, 30 minutes is too far down. So yeah, as you can see, broke structure here as well, came back. But if you look down here now, you can now see that this kind of setup also happened, so creating opportunity for the sellers as well, if you notice, right? So as you can see from here, right, price broke structure as well to the downside, yeah, then came back, gave us a break of the candle, and that was an opportunity for the sellers. You get that? So this is basically how price forms. It gives you that order block, comes back to the area of interest or the point of interest, and it gives you your entry. That is basically the concept of POIs in supply and demand. You know, point of entry or point of interest comes to the supply or the demand, you get your entry and you move. Of course, this is a disclaimer, it is not as easy as I'm making it seem, especially on this video, because this is just an introductory video. As we go on, I'll introduce concepts like liquidity, like inducements, and so on. Those are advanced, more advanced terms, but this is just all you need to know for now at the stage of this learning, right? These are other blocks, these are the concepts, these are how to spot break of structure and know, okay, this is where we're at in the market in terms of positioning, right? How to see when the market is making higher highs, higher lows, how to understand the concept of the market cycle, the external ranges, you know, and everything I spoke about on this video so far. So yeah, one more thing, fair value gaps as well, right? Fair value gaps are somewhat different, a different kind of POI, right? Not ideal for this video, but as we go on, I'm sure you will understand what fair value gaps are, right? So do well to go through all this material that I've put out today, you know. Look at this from the order blocks to the breaker blocks. Oh yeah, the breaker blocks, I haven't explained that thoroughly. If you notice, let's assume price breaks through this order block that has been created here now, right? Breaks through, then comes back, breaks through here, then comes back. So this order block, this same order block can serve as, here is a demand right now, so it can also become a supply, right? So when that happens, this OB becomes a breaker block. If this happens, price comes here, does this, so this demand zone has become a breaker block. So you will continue looking for sales from this point, right? So that's basically POIs, that's basically order blocks in a nutshell. So as we go on, you get to understand more about these terminologies and how they are applied in real market scenarios, right? So I think that should be all for today's video. So I'll see you on the next episode, guys. Peace and love. That was a lot of information, I know, but you know, in this game of precision and patience, recognizing points of interest like order blocks, fair value gaps, and breaker blocks gives you the edge to anticipate and not chase price. When you understand the market cycle and how price moves from accumulation to advancing to distribution to descending phase, you stop reacting emotionally and start thinking more logically, right? The goal is not to predict the market, but position yourself where probability is on your side or in your favor, right? Every zone tells a story. Every reaction has a reason. Study the footprints, trust the process, and remember, this is an infinite game. In the next episode, we'll be covering like how you understand market traps, liquidity, and definitely how to avoid being one, you know. Until then, don't chase trades, guys. Let the trades come to you and play the game to win. If this episode was of value to you, be sure to like, subscribe, comment. I want to know what you think. Like, I want to know how I can improve these videos and make them better for you. So that being said, guys, play the game to win. Peace.